Morning, everyone, and thank you so much for braving the rain to be here with us this morning for what promises to be an extremely interesting and thought-provoking presentation. This presentation is part of a lecture series that we started in April this year called Globalization in Question. The reason for this lecture series, I suppose, is self-evident as the global consensus is going through many challenges and the new is yet to emerge. We thought we had an interesting opportunity to draw on the intellectual powerhouse of our lecturers to really think through some of the most pressing questions of our time. We are really privileged today to have Jahangir Aziz in our midst to talk to us about globalization in question. Jahangir Aziz doesn't really need an introduction to this audience, but I'll just say, for the sake of form and formality, he is the head of EM Asia Economic Research at the JP Morgan. He joined the firm in late 2008 as India Chief Economist, prior to which he was a principal economic advisor in India's Ministry of Finance. So over to you, Jahangir, and thank you everyone for being here, and thank you especially for agreeing to come.
Thanks very much. Look, my association with this center has been for a long time when I first joined the government. Since then, I'm really appreciative and grateful for the constant interaction. Many of you may not know this, but many of our JP Morgan clients almost always come and visit CPR. And CPR staff has always been invited to our JP Morgan conference. So we will have long interaction. It helps to have friends like Partho around, but I was just mentioning that I'm thankful he's not here, otherwise he'd be asking the uneasy questions. Just before I start, I'm going to try and be as brief as possible, and so that time for questions. I think there is a question that is not really appreciated, how much globalization has an impact on India. And I landed up from New York last Tuesday, had meetings on Wednesday and Thursday with government officials, all of the concerns about growth coming down and what needs to be done, etc. And I'm not going to go into that, but I think a very large part of what not just this government, but the previous government, UPA 2 in particular, had missed and continue to be missed, and Indian policymakers continue to miss, is the massive dependence India has on global trade, which somehow or the other has been downplayed in this Indian exceptionalism argument that we have lived through over the last 20-25 years, saying that India somehow defies the laws of economics and India is an unique, exceptional economy that is not part of the global trends and and connected to the global economy. And many of our policies and reforms, not many, I would say a significant portion of our policies and reforms, have been less effective, partly because we haven't recognized that at the level of policymakers. And I would say it's not just a level of policymakers. Toshi Jain, who is a colleague of mine who sits out of Bombay and covers India, can vouch for it, that the number of analysts and market participants who he meets who still has that belief. So let me start with a story before I get into all of this. I came to India. I never worked in India in my life, joined the government of India back in 2008, and the first time I realized how connected India was to the global economy was in the Lehman crisis. I think it was September 9th, I don't exactly remember the date. On that Friday, Lehman went down. New York markets, remember we are 12 hours ahead of New York markets, so our markets weren't open. Monday morning, the interbank rate, which on Friday had closed at around 6.5%, started the trading at 27%. The entire shock of Lehman crisis took just that weekend to completely get transferred into India. And that was a time when we realized that, despite all the talk that we have about how closed India is or how buffered India is against exogenous shocks or global events, it isn't. So in part, the talk will be spread into two parts. One part is, which I'll begin with, is this, that India is far more open than you think it is. In JP Morgan, by the time, I left the government and joined JP Morgan, and back in 2012 is the first time I wrote this note called More Open Than You Think, and I think subsequently Toshi and his colleague Sajid Chinoy have updated these data. So much of what you will see in the next few slides is essentially the updated thing, and I'm thankful to Toshi for doing that. I'm going to start with this this chart. So if you look at sorry, so if you look at the chart on your left-hand side, the chart basically has title India's growth drivers. There's nothing magical about the chart. It just shows consumption, investment, and exports as a share of GDP in India. And if you look at the period from 2000 to 2002-3 to 2007-8, when India grew at that 8-9%, the real driver of growth was the orange line, which is basically private investment. So private investment, and the scale of the private investment, as the arrow shows, is on the right-hand scale. So private investment rose very sharply, and that was the miraculous change that happened in India. It was the corporates who started to invest after corporate investment had been languishing for many years prior to that. Now, investment has a way, the thing that investment does is that it creates capacity. It creates things. And somebody has to consume those things. Somebody has to absorb those things for that investment to be successful and corporates to continue doing that. So if you look at who absorbed all that capacity that investment created, there are essentially two groups of people: the orange line, the black line, and the blue line. The blue line is private consumption as a share of GDP, and the black line is exports, foreigners' demand for or consumption of Indian goods. As you can see clearly, the entire increase in investment and the capacity that investment created, it wasn't the blue line that was picking it up. It wasn't. India went through these massive expansion of shiny malls and expansion of consumption, etc., etc., etc. But at the macro level, it wasn't the shiny malls, even though there was a massive proliferation of that. That wasn't the source, or that wasn't the way in which the capacity that was created by the orange line was being absorbed. It was the black line. It was this doubling of exports as a share of GDP from around 10-12% to about 25-26%. That was what drove almost all the absorption of Indian output, that additional output that the new investment was creating. And if you look at the period after that, 2012 onwards, from where the orange line starts to dip, i.e. corporate investment does not pick up and turns negative, which is the reason what everyone will point out and say that's the reason India is slowing down. Notice it is not the blue line that is dipping as much as the black line is dipping, i.e. it's the foreigners who no longer buy the stuff that we are producing, which is why corporates are no longer investing. It is not a complicated story, but it's a story that goes against the established view of what India is. There is a nice closed economy driven by domestic demand, driven by Indian consumer, the famed Indian middle class who is basically consuming all that is produced, and the answer is that's not true. So just to give you a sense of what the changes were, look at the charts on your right-hand side. Look at the chart on the top panel. That's the change in these shares between 2000 and 2011. It is private consumption that fell by almost 6 percentage points. Government consumption fell by almost 4 percentage points. What really picked up was exports that rose by almost 13 percentage points to absorb the capacity that the investment growth of 8, 12, 9, 10, 12 percentage points that took place over that period. Look what happens after 2011 and 2012. Investments share falls by almost 8 percentage points from 2011 to 2016. Export shares fall by almost 7 percentage points, almost the same amount. Invest Private consumption also falls, not by as much. What really picks up in this entire period of time is government consumption. Almost all of India's growth has so far been driven by government consumption. And there's a lot of debate about fiscal stimulus, etc., that you must be reading about in every newspaper and every television channel right now. And Sajid and Toshi have been working on this for a long time, and they will tell you that central government fiscal deficit has come down, not as much as we would like it to have, and that's what people are looking at. People are forgetting that the entire decline in in the central government's fiscal deficit, the entire decline, has been more than offset by a rise in state governments, a rise in state government's fiscal spending, and so much so that the overall fiscal deficit of India over the last 3 years hasn't moved at all from 7% of GDP. There's an enormous amount of fiscal stimulus in India. And you have to put that in context. This is 7% of fiscal deficit in India, when oil is at average about $45 a barrel over the last 3 years. It is 7% of fiscal deficit when India's growth, if you believe the CSO numbers, average around 8%. So, which is what is reflected in the increase in government consumption's share in this period from 2011 to 2016. And all of the point I'm trying to make is that one has to accept this reality or explain this reality away against the sort of received wisdom that India is a closed economy, that almost all of India's woes over the last few years of declining growth, of declining corporate investment, is probably largely driven by the fact that exports as a share of GDP or export growth has been faltering. So I'm going to stop there and go to other indicators, and I'll come back to this. So what other measures of openness can we point to? Then there are standard measures of openness. I'm going to start with the panel on the top left-hand corner. That's just export plus imports divided by GDP, the standard measure of openness. India's exports and imports divided by GDP was around 30–40% till about 2004–5. It had reached almost 60% of GDP by 2011–12, and it's now come down back to around 40% of GDP. Let's look at financial openness. Capital inflows plus outflows, the amount of transaction India does with the rest of the world, that was around 20–25% of GDP till about 2004. It completely jumps up to about 50–55% of GDP and holds at that level throughout this period. India is not a closed economy. If you look at current account and you take away oil, India has been running a current account surplus like any other export-oriented or export-promoting Asian economy of around 2–3 percentage points of GDP. Oil is the only thing that drags India's current account into negative territory. I'm going to leave the real effective exchange rate later and then come back to it. And this is a chart that we didn't calculate this at first. It was Reserve Bank of India calculated this, and we simply updated that. So the question that RBI had asked, this is about 4 or 5 years ago, Toshi? Yeah, 4 or 5 years ago, was that what percentage of India's manufacturing is domestically consumed and what percentage of India's manufacturing is consumed by foreign demand? That's the blue line. And the blue line has relentlessly increased, and peaking almost at 55% of all India's manufacturing is exported. That has come down, obviously, in the last few years. If you look at the blue line on the left-hand side chart, that's because exports have slowed down. But even in manufacturing, India had been exporting more than half of its manufacturing, of all the manufacturing it does. And again, the other charts are again things about how much of that manufacturing, where was that manufacturing happening. It wasn't in textiles. If you look at the chart on the top left-hand corner, textiles share had gone down. Gems and jewelry remained broadly flat. Leather had gone down. Where were those manufacturing? In engineering goods and chemical goods. So even in manufacturing, which again, we have the sense that manufacturing, a lot of it, we believe that manufacturing is exported, but no one really thinks that more than half of India's manufacturing is exported. More than half of India's manufacturing is exported. And so the point I'm trying to make is that however much we might want to deny it, much of our prosperity over those 6-7 years prior to the global financial crisis was driven by foreign demand, and much of the decline in India's growth in the next few years was also driven by a slowdown in exports. And this is where the globalization question comes into play. What's really happened to global trade and where are we at this point? So now I'm going to shift from India to the global perspective, and this is a chart that sort of, explains almost everything, right? And, the other charts are important, but not as important as this one. So there are two lines. This is global trade, percentage growth rate. The blue line is the actual volume of global trade, and the orange line is the value of global trade. So the difference between the two of them is what happens to the prices of exports. And if you look at the orange and the blue line throughout this period, the blue line, for example, averaged around 10% growth every year. In the global financial crisis, the blue line collapses, goes into negative 20%, then jumps up, recovers to about 10%, and then there is this period where the blue line flatlines from 2011 to 2016 almost at around 2% growth rate. That's the sort of the pushback on globalization that's happened, where global trade completely ratchets down and remains at that flat level. It has picked up a bit, and we will argue, and I will argue that much of that lift has been not to do with manufacturing exports. Almost all of it has to do with commodity export, coal and things like that. But look at what's happened to the prices, which is the orange line. Almost a similar story, except that the volatility and the fluctuations in the orange line is much more than the volatility in the orange line. Now, the volatility in the orange line is important, particularly the fact that, orange line from 2014 onwards falls very sharply, goes into negative territory, then recovers. It's an extremely important thing for many emerging market countries who are commodity exporters: Brazil, South Africa, Russia, and then, of course, the oil exporters. It is not so much that important for India, except that India benefited from the decline in the orange line because we were net importers of commodities. But that's a separate story. But it did devastate Brazil, did devastate South Africa, Russia, etc. That decline, that orange line. But the important point is that the blue line in this period of time, 2011 right up to 2014-15, and the little uptick that you see now, it is many factors lower than the blue line prior to the global financial crisis. And just to give you a sense of what that means, This is not growth rates, but these are levels of global trade. So, what is the actual level of global trade that's taking place? And don't look at the chart that much on your, on the left hand side. Look at the chart on your right hand side. The squiggly blue line, solid blue line, is what actually happened. And the growth rate in that is the blue line that we talked about in the previous charts. But these are the level. So you see, you have a level of global trade that is moving up extremely sharply from 2000 to about 2006, 7, 8. It collapses, it comes back up, and then again it starts moving up. The problem is the trajectory and the slope of these lines, which is the growth rate. If I actually go back and say, suppose globalization had continued at the same pace before, the same pace as before the global financial crisis, what would have been the level of global trade today? That's the dotted line. And if you compare the end of the dotted line, where it should have been, if it had continued at the same pace as what had actually happened, which is a solid blue line, you see this massive yawning gap in the level of global trade. That's the amount of global trade the world lost in post the global financial crisis. And I will argue that almost all emerging market economies, including India, except China, all emerging market economies except China, policies post the global financial crisis, so the last 6, 7 years, has been anchored by this belief that the solid blue line, one day, if I wait long enough, will go back to the dotted blue line. Therefore, I have every emerging market country, including India, let's play a little bit with monetary policy, let's play a little bit with fiscal policy, let's do a little bit of reforms here and there, and as long as we wait long enough, the blue line is going to go back to the dotted blue, the solid blue line is going to go back to the dotted blue line, and the world will go back to the happy place. The big question at this point in time is that what happened, why the solid blue line did not go back, or solid blue line was that much flatter than the dotted blue line, and will the solid blue line ever go back anywhere close to the dotted blue line? And that's a question that don't really have very many answers to, both in the cause and also where it might go, but I'll try and answer some of the reasons. So why did this collapse happen? There are many reasons as to why the collapse. So before I go into the why did the collapse happen, just to tell you, just to show you how important globalization is and global trade is to the global economy, to emerging markets, not just in India. We talked about India previously. Look at the chart on your left-hand side. The chart on the left hand is a very simple chart. It has the same blue line that we talked about, we showed at the beginning what was happening to the volumes of global trade. And the orange line is just the actual growth rate of emerging market countries, the average growth rate of emerging market countries. And as you can see, by more or less, it's the same line. There are very small periods of time when the orange line and the blue line depart in any meaningful manner. So what are the usual suspects? Well, the usual suspect is, well, developed markets were not growing. Well, if developed markets, US and Europe and Japan were not growing, then obviously emerging market can't grow because that's where the demand is. Those are the guys who are consuming our stuff. So let's look at the chart on the right-hand side. That's the chart where I have the same blue line. I've simply replaced the blue line, the orange line, instead of emerging market growth with developed market growth. So in this entire period of time, when global trade flatlined, blue line languished, 2012 onwards, the orange line picked up. Developed market economies have recovered. They have more or less close to where their potential growth is. They are not going to go faster than what they're growing now. And they did not depend on the blue line. They did not depend on on the. So even though global trade faltered, developed markets actually did pick up, even though they had a very bad time during the global financial crisis, did pick up. The orange line did pick up in the last 4 or 5 years, despite the fact that the blue line did not pick up. Whereas the emerging markets, which is the chart on your left-hand side, there the two lines are completely tied together. And that's the difference of being an emerging market and being a developed market. Just to make more of that, make the same argument but slightly differently, the chart on your left-hand side is emerging market GDP growth rate, which is the growth rate, which is the orange line, and the blue line is developed market growth rate. It's basically the same chart. I'm just putting in terms of growth. The blue line has recovered. Developed markets have recovered. Waiting for developed markets to recover is not going to get us anywhere. They have done it. It's the orange line that hasn't picked up. And therefore, we have waited for 5, 6 years for developed markets to recover, and I keep hearing from both emerging market policymakers as well as Indian policymakers, well, developed markets are starting to recover. No, they aren't starting to recover. They have recovered. It's done. At best, they will be able to maintain their growth rate. In fact, on the seventh year of expansion, the probability of a recession in US in the next 2 years is now higher than 50%. So now we are waiting, now we are entering the phase where the US in the next 2 years has more than 50% probability of going into recession. Waiting for developed markets to recover is not any longer an option. It's done, finished. And in both other emerging market countries and the big elephant in the emerging market emerging market group, China, both their fates are essentially tied together. It isn't that China was doing anything different. The other argument is that fine, developed markets have recovered, but they are no longer importing as much. They have turned inwards. The chart on your left-hand side is what's happening to developed market growth and imports. So the blue line is actual growth, the one that you've seen before, and the orange line is the actual imports by developed market. Yes, the orange line has not kept pace with the blue line as in the past. In the past, the orange and the blue line, as you can see clearly, were very tightly closed. This time around, imports did not pick up as much as the pickup as much as at the same pace or the same level as it should have picked up. So yes, developed markets aren't importing as much as their income increases should suggest, but it's not a very big difference. If you look at the exports by emerging markets to developed markets in emerging markets, the real sort of shock that happened, the real collapse that happened was that both emerging market, not real collapse, but both emerging market and developed market exports declined. And the recovery that you're seeing right now is the recovery in the blue line, which is the emerging markets exporting the emerging market. The reason as to why this becomes important is the following, that if you go back again to the caricature or the standard description, for the lack of a better word, about what was happening in that period when emerging markets were growing, China, India, etc., the caricature is something like this, that developed markets grew, emerging markets, for reasons of China entering the WTO, for other countries deciding to lower their trade barriers, etc., for a whole bunches of reasons. Early 2000, much of the increase in developed market demand was being fulfilled by emerging market exporting. And emerging markets did not have the capacity to export or to meet that export demand. So whenever developed markets growth increased, let's say by 1 percentage point, their import demand, let's say, increased by 3 percentage points. That led to a massive increase in demand for emerging market exports. Emerging markets did not have the capacity to export, so the emerging markets created capacity. That's where the corporate investment pickup takes place in India. This is the supply chain expansion that takes place across the world. That Gap US orders 10,000 jeans. 10,000 jeans cannot be supplied by any single country. It gets split up into buttons being made somewhere, the yarn being made somewhere, it being cut somewhere, it's being sewed somewhere, it's been packaged and sent back to US. And these capacity, these supply chain creation was part of the investment increase that takes place in emerging markets. So as a result, not only is there an impact coming from higher exports, but that impact is multiplied by investment within emerging markets responding to the higher exports by increasing capacity. So there is almost a multiplication of that impact. And therefore, 1 percentage point higher developed market growth has a more than 1 percentage point increase in emerging market growth. That's the point. If you look at the data and you look at what happens to emerging market growth when developed market grows by 1 percentage point, that's the bar chart on your right hand side. And the caricature is true from the period 2000 to 2011, the blue lines. So blue line tells you that what happens to emerging market growth if developed market grows by 1 percentage point. And if you look at overall emerging market, the bar chart on your extreme left hand of that figure, it is higher than 1. It's like 1.2%. So every time developed markets grew by 1%, emerging markets grew by more than 1%, by 1.2%. Look at what happened from 2012 onwards, the orange bars. Today, when developed markets grow by 1%, emerging markets do grow. It is not that the emerging markets don't grow, but now they're growing by 0.3. And that's the collapse that's happened in emerging market in global trade. That in the past, when the supply chains didn't exist, then every time you had that 10,000 jeans orders from Gap, you had to expand capacity in your own country. So you had to invest. You had to create, infrastructure. You had to create platforms for trading, factories, etc. But by 2012-11, you had already reached a capacity of the supply chain that was sufficient to now meet the meet the 10,000 jeans orders from Gap without having to expand supply chain. Consequently, the impact on growth now is just the export impact. There is no multiplication of that through domestic investment responding to the higher exports. And that's the change in dynamics, which is something that, as I said, is not just in India, but it's across the world. Emerging market policymakers, except one country called China, that seems to have been lost on their policymakers. And consequently, when we are making policy choices, when we're thinking about reforms, we are still thinking about the world of the blue charts or the blue bars. And therefore, we are still waiting for DMs to recover, which is not going to happen because they've already recovered. Still waiting for global trade to recover, and it's not going to happen because the supply chains have come to a point where supply chains expansion doesn't need to expand when there is an increase in export. And that's a massive change in the internal dynamics of globalization that separates the period from early 2000 to 2012 and 2012 to today. I'm going to talk a bit about inflation before I move out to the other parts of the presentation. This is just an aside, and it's an aside, it's an important aside, because it tells you what is the what are the implications of the other or the other implications of globalization. So remember when we looked at the nominal trade growth numbers and the real trade growth numbers, you had this huge spike, huge change in the orange line of nominal trade, and we all talked about that this was part of the commodity cycle, and that commodity prices collapsed in 2014 onwards. Oil went from about 110 to $25 a barrel. Every commodity prices collapsed, and then there's been a recovery since then. So if I look at and in this recovery period, the people looked at it and said, okay, fine, things are getting back to normal. Why are things getting back to normal? Where prices are going back, the world is not deflating, disinflation is coming down, we're getting some inflation back, which is a good sign because it's a sign of activity picking up, etc. And all of that story is true, but not in emerging markets. So if I split inflation dynamics between developed markets and emerging markets, this is the picture that I get. So if I look at the chart on my left-hand side, the chart has two lines. It has something called PPI, which in India is called WPI, so wholesale prices, and the chart and the line which is CPI, which is the orange line. Why is that distinction important? So if you think about industries, there are upstream industries and there are downstream industries. Upstream industries are the intermediate producers, the steel guys, the coal guys, etc. And downstream producers are the ones that produces shirts and shoes. Downstream items are the ones that enter into what we call CPI, and upstream prices are the ones that enter into inputs, which is called PPI, Producer Price Index. So what did the commodity cycle do? The commodity cycle collapsed so that the producer prices fell, and then it recovered so that the producer prices went up. In reaction to that, if you look at the chart on your left-hand side, the orange line, the scales are different because they're in two different kinds of scale, but the orange line has closely correlated to the blue line. So all the increases in the input prices in the last 18 months, 24 months, the blue line going up, has been passed on to downstream prices, which is where the consumer goods, shoes, clothes, etc. Look at what's happening in the emerging market world. The blue line has moved up exactly the way in which the blue line moved up in developed market, basically because both the blue lines are driven by the same thing, global trends. But look at what's happened to the orange line. The orange line not only hasn't moved in tandem, but it's gone the other direction. So upstream prices have gone up, input costs have gone up as commodity prices have gone up. None of that has been passed on to downstream prices or actual consumption goods, final goods. This is a sign that final demand or pricing power, whichever way you want to call it, continues to be extremely weak in emerging markets. That's when firms are unable to pass on costs to final goods. It's when the pricing power or the demand in this thing. So my point is that all of this talk about globalization or global trade coming back is a story that's far more nuanced than we are willing to accept. And the thing is that there is now a massive distinction between developed markets and emerging markets. The recovery in developed markets is real. Developed markets have recovered. And the proof of the pudding is the fact that when upstream prices go up, downstream prices also go up, which is the chart on your left-hand side. There is enough demand, there is enough pricing power, therefore, for producers to pass on input cost increases to final goods. That's not the case in emerging markets. Emerging market corporates are still unable to pass on the increase in input costs into final goods because there isn't yet sufficient demand. And that's where the disconnect that's happened, all part of this change in globalization, the disconnect that's happened between developed markets and emerging markets, which we have an idea about, which we start believing, we believe in it, and unfortunately that belief is no longer true. Why did all of, sorry, go ahead. that is a hard thing. Yeah.
Why do you say there's no?
Because of CPI, when CPI inflation went down, when PPI inflation went up. So
Yeah,
if you
look
look,
at the emerging markets.
yeah,
CPI is shooting up.
no CPI, no
is down.
CPI is the orange line.
Oh, well, then that's not what the thing says. It says
No, orange line is CPI. PPI is the blue line.
the chart says is that it's the blue line that's CPI.
No, no, no.
The arrows.
Look at the arrows.
Color of the arrows is an indicator and not the direction.
Sorry, Monte.
No, I can see that. Just that you have an arrow pointing to.
Yeah, the
No,
color.
it is point. No. Arrows to tell you which scale you should look at. The reasons there are multiple reasons, and again, as I told you, we don't really have a single smoking gun to tell you this is why it happened. There are many reasons. I'm going to go through some of the reasons. Some of the reasons are mostly tautological. I'm only describing the data rather than actually giving you a reason. Reason. So let's start with the first thing that yes, developed markets no longer are consuming or importing less, and which is somewhat true as we looked at the chart over there. And that's a big factor in the slowdown in global trade. So just to give you numbers as to, or give you some indication of that. So let's look at what the overall number says. So I'm now looking at emerging market Asia only because data for the overall emerging markets is much more difficult to get than emerging Asia. Emerging Asia is much better in collecting trade data. So if you look at the chart on your top left-hand corner, G3 is US, Euro area, and Japan. So basically, I'm looking at what was happening to emerging market real exports and how much these three countries, Europe, US, and Japan, were importing. So if you look at what happened to exports, the blue bar is the average growth rate of exports of emerging Asia from 2004 to 2007. And the average growth rate was around 12 percentage points in volume terms every year. The orange bar is what was growth rate in 2012 to 2015. 16 is slightly higher, but the average does not. You can't even see the orange bar anymore. It was running around from 12%, it dropped to about 1 percentage points. These are volume growth rates. So there's a massive shock that hit emerging markets. Look at what was happening to G3 imports. You get a similar sense that, yes, G3 imports were probably responsible. In the past, G3 imports were growing at around 6%, the blue bar. Today, they have been growing around 2-3 percentage points. The chart on the top right-hand panel, it tells you which are the countries where this decline has taken place. If I look at Japan, Euro area, and US, Japan is the black bar portion, European Union is the orange, and blue is US. The contribution of G3 economies was in the past from 2004 to 2007. Both US and Europe were equally contributed to import demand or export demand from emerging markets. And Japan had a healthy 3 percentage points contribution. In the 2012-2015 period, the black line disappears. You can't see it anymore, which is Japan's contribution almost goes to zero. The orange line turns negative, so there's a lot of import substitution that's taking place in Europe. And US is the only country among the G3 that is providing any support to global trade at this point in time. It is less than in the past, but it's the only support that's coming There is nothing coming out either from Europe or in this thing in terms of their contribution. So where are the big, why do I think, or how does one make sense of that? So that's the chart just bottom of the, on the bottom right hand corner. It's called global RER. RER is real exchange rate. So this is exchange rate adjusted for price differences, local price differences. And that's a measure of competitiveness, that what is happening to your real exchange rate. And if you look at this period from 2012-16 to 2004, 2008, look at Europe, EU, look at Japan, look at US, look at EMEA is emerging Europe. So these are Hungary, Poland, Czech Republic, Turkey, etc., South Africa. Latin America is Latin America. And the two bars that stand out on your right-hand side are Asia and Asia ex-China. So this entire period when every other country and country bloc depreciated their currency in real terms. Exchange rates are relative prices. Not everyone can depreciate, not everyone can appreciate. If your depreciation has to be my appreciation, depreciation has to be your appreciation. All of that adjustment was done by Asia. So when we talk about Kiwi, EMEA, emerging Europe and Latin America, not part of Kiwi, but if you look at what happened to quantitative easing and this massive easing that takes place in the last 5-6 years, one of the implications that not many people, I think Raghu had talked about it 2-3 years back, but not many people talk about it openly, is not the impact on interest rate, is the impact on their exchange rates. The exchange rate depreciation has been significant in Europe, in Japan, and in US, i.e., all three countries have gained significantly in terms of external competitiveness. Emerging Europe and Latin America, there the depreciation hasn't been that much, but at least it has not gone and appreciated. The entire burden of Kiwi has been picked up by emerging Asia, including India and China. And consequently, at least in terms of geographical distribution between who suffered in terms of exports, most of the burden has been picked up by Asia, China, India, Korea, ASEAN, Taiwan. And one of the causes that we don't talk about more frequently is the fact that Kiwi led to this massive improvement in competitiveness by the G3 economies. And I'm going to end with this chart on US equipment investment. Couple of reasons it's an interesting chart, and it tells you a lot about why the parts of global demand that's been changing, or developed market demand that's changing. So this is US equipment spending. Why is equipment spending important? Because that's one of the so there is this view which has been propagated for a long time that China produces all these plastic frisbees and consumer goods, and that's what the Americans consume, or that's what the Europeans consume, etc. It's a good story. Quantitatively, it has a very small impact on either China's or Asia or emerging markets exports or US's imports. The real big movers are equipment, machinery, tractors, telecom equipment, auto parts equipment. That's the big driver of exports. So if I look at equipment spending by US, the blue line is tech equipment, which is extremely important for North Asia, and the orange line is non-tech equipment. India is part of the non-tech equipment. Both of them used to be around 2%, 2.5 percentage points of GDP prior to the crisis. In the crisis, the blue line and the orange line both fall. And then after the crisis, the orange line picks up. Non-tech equipment picks up. But the blue line doesn't pick up at all. And if you just eyeball the blue line is now running around, let's say 1.5, just to have round numbers. And the blue line in the past would run around 2. So it's 0.5% of GDP lower equipment demand, tech demand coming out of US every year. 0.5 multiplied by, let's say, 5 years is about 2.5 percentage points of US GDP. US is a $20 trillion economy, and you can imagine so that's almost a $500 billion loss of demand from tech demand coming just out of the US. Now the orange line picked up. But the entire pickup in the orange line was driven by shale gas equipment. And consequently, the people who, emerging markets do not produce equipment for shale gas and things like that. So the fact is that there are structural changes that have taken place. One of these structural changes is the fact that U.S. No longer demands the kind of tech equipment that they used to demand in the past. The other argument is the one that I made, that the emerging market supply chains have all matured, i.e., in the past, when going back to the same example of 10,000 jeans was ordered by Gap, it would lead to actual increase in capacity in factories and infrastructure, etc., in the countries in which were part of that supply chain. Having expanded the supply chain for many, many years, these supply chains have reached a capacity where now, when Gap makes the same $10,000 order, you can fulfill it without expanding the supply chain, without doing any investment. To give a sense of why that, how much of that is true, I'm going to look at, I'm going to start with the chart on the top left-hand corner. The chart on the top left-hand corner shows you the percentage of exports from emerging markets, or emerging Asia in this case, that goes to emerging markets, to other emerging markets, and the percentage that goes to developed markets. So if you look at the entire period from 2000 to about 2012, remember 2012 is when global trade collapses. So think about the global chain caricature. So U.S. puts out an export order to China. China receives that export order, then that export order gets split up into India, Vietnam, Mauritius, wherever it is for different parts of that. All of those countries produce different intermediate goods. Those different intermediate goods are exported back to China. China packages them and then ships them out. That's the global manufacturing chain. So if that is true, then what you should see is a lot of increase in emerging market to emerging market trade. That was what, back in the 1990s, we all talked about South-South trade. There is no South-South trade. There is South-South trade is only part of the South-North trade. And if you look at the South-South trade, which is the blue-orange line, the orange line did move up and moved up, and essentially since 2012 have flatlined. So all of this inter-emerging market trade, all of the South-South trade was all part of that supply chain. As the supply chain matured, there has been almost no expansion of South-South trade or emerging market trade. Again, exactly the same thing has been shown in the shares of exports going out from emerging Asia to different parts. You haven't seen any increase in the share of trade that is going to other emerging markets after the pickup that takes place in that period from 2004 to 2008-9. I'm going to leave behind the other two charts, but again, those two charts again have the similar kind of story. I'm going to focus mostly on the chart on the bottom left-hand corner. One of the other example is China, that apparently China today is producing many things on its own. It no longer depends on exports or imports from other countries, i.e. that China's own import intensity has come down because China is basically import substituting a lot of things. That was true. So if you look at the import intensity of China's exports, which is a fancy way of saying how much imports does China make for every unit of exports, it did fall. It fell very sharply from 2002 to 2008. The squiggly line on your bottom left-hand corner. Since then, it's flatlined. So yes, China did import substitute, but that was an old story. That's a pre-GFC story, global financial crisis story. It's a pre-decline of globalization story. Can't point a finger in China and say that China is to blame for all of this. Again, as I said, I'm not going to be able to give you any explanation as to why globalization came to an end, but I'm going to throw out some maybe possible explanations. So let's talk about the recent recovery. Everybody is talking about the recent recovery that's taken place in global trade. And I'm going to start with the chart on the top left-hand corner. The top left-hand corner breaks down exports by commodities and manufacturing. Manufacturing is the black line, and the blue line is commodities. As you can see, almost all of the pickup in global trade that we have seen in the last 2, 3, 4 quarters is been driven by commodities. It's not happened in manufacturing. I'm just going to end in this section with just one chart, which is tying back U.S. equipment spending. Remember, I talked about U.S. equipment spending and looked at tech versus non-tech. And just to show you how important U.S. equipment spending is, look at the chart on the bottom left-hand corner called U.S. equipment spending and emerging markets, emerging Asia's exports. Orange line is emerging Asia's exports, blue line is U.S. equipment spending. That's the driver. It's not consumers. It's not what is sold in Walmart. Walmart is important, I'm sure, for a bunch of people, but that's not what drives. What drives is how much corporates, how much firms actually spend on investment. And if that doesn't pick up, emerging market exports isn't going to pick up. And that's a big change, as I said, has happened. I'm going to talk about just one bright spot before I try to come to the closing of this thing. The bright spot over here is what's happened to the tech industry. So if you go back to the tech industry, which the reason why tech industry is important is because that drives what happens in North Asia. So Korea, Taiwan, and China, Singapore to some extent, Thailand also to some extent are extremely dependent on the tech cycle. And I'm guessing at some point in time it will become important in India. So if you look at what's happening to tech cycle, what is remarkable in tech cycle is the chart on your top left-hand corner called global semiconductor billing. So that's basically the amount of exports of semiconductors that's taking place. And if you look at it, the black line or the blue line or the orange line, it's really the black line that's moved up, which is Asian exports of semiconductors. The black line did move up reasonably at a solid pace till the last few quarters, so 2015, where the black line shoots up. And the reason why that is important is because till now, till this last 4, 5 quarters, I would say 4 quarters, most of electronics or most of computer-related equipment, etc., was being driven by telecom, by handsets, by whether you have iPhone 6 or iPhone 7 or iPhone 8, and whether Samsung is going to put out a new notebook or the other, which is what you see in the bottom left-hand chart. That this is for Taiwan. Taiwan is a bellwether country. It's very much tied to iPhone and iPad sales. If you look at the panels on your right-hand side, what is interesting is that you actually do see semiconductor output and exports also pick up. So that's just basically saying that the black line on your top left-hand chart, which was semiconductor revenue or value, is not just value, there is also volume response to it. But the most interesting chart is the chart on the bottom left-hand corner, that for the first time in many, many years, we actually see capacity expansion taking place in semiconductors, both in Taiwan and in China and in Korea. We don't have data on China, but I'm guessing it's also true in China. Now, why is all of this important? It's important because that semiconductor industry no longer depends on telecom. That's one thing. The second thing is that probably for the first time after talking for 10, 15, I don't know how long, about artificial intelligence, big data, cloud computing, for the first time we are actually seeing evidence that maybe that has already started to come. So most of this semiconductor demand growth that has taken place over the last 1.5 years is not come from telecom industries. It's actually started to come from Siemens and General Electric. So if you ask the Siemens and the General Electrics of the world, they are embedding, because of big data, because of cloud computing, etc., they are embedding real-time response, real-time things to measure the responses of machines, the responses of refrigerators and airplane parts in real time back to the manufacturers. Or I'm saying all of this is because this is part of the globalization. Again, we are probably missing. So if you go to GE and if you go to Siemens, and Samsung will probably do that very, very soon, or probably is doing it. I don't have visible, I haven't spoken with them. But if you talk to them, think about a refrigerator. The new refrigerators that they are making are not are refrigerators where every part of the refrigerator has an embedded semiconductor and it in real time sends out messages through big data and cloud computing of what is happening to the refrigerator. It will tell you whether the fan is moving in the right pace, whether the compressor is moving in the right pace, whether and the new business model that's sort of about to come is that you no longer buy a refrigerator from any of these people. You almost rent a refrigerator for 10 years. You sign 10-year service packages, and you will get a phone call from Samsung and mechanics saying that are you home on Tuesday? I'm going to come and replace the belt of the compressor because that's almost about to wear out. Prices of refrigerators and other such things, therefore, will fall. The initial price that you're going to pay is probably going to be 50% or half, or maybe even less than half of what you pay right now. Instead, you will be tied to 10-year contracts, 15-year contracts, service contracts. That's exactly the same thing they're doing with their GE jet engines. They're doing it with almost everything. The reason I'm saying all of this is because this change in big data, etc., actually raises serious questions about the location of supply chains. Do I really need to have decide that the physical location of my supply chain has to be in China because Air China has, I don't know, 1,000 planes, of which half of them use GE engines. Therefore, does GE have to have presence in China any longer? Or does GE sit out of its New Jersey headquarters and get information on real-time basis? And therefore, my point is that there are significant changes that are coming whose likely, and I don't know the impact of it, whose likely impact is probably going to be lower prices and probably going to disrupt that supply chain even further. I'm going to start winding down very quickly. I'm going to just show one more chart. Why does all of this matter? Well, it matters because of the following chart on your top left-hand corner. That we worry about capital flows, we are worried about investment, etc., etc., etc. And in reality, almost all of capital flows, as a market economist, I'm going to talk to my clients about what's happening to the U.S. Treasury rates, what the RBI's policy is going to be, all of that stuff. In reality, none of that actually does matter. In reality, the only thing that matters is how fast emerging markets are growing vis-a-vis developed markets. So The blue line in every one of those charts is just the growth differential between emerging market and developed market. The orange line in every chart are different asset prices, relative asset prices. So the orange line in the chart on your left-hand corner is the average foreign exchange. The orange line on the right-hand chart is the equity price in emerging market versus that of S&P. As you can see, the blue line and the orange line move in very close tandem, i.e., for capital flows to come in, for asset prices to outperform developed markets, emerging markets need to grow faster than developed markets. And the growth differential matters. The wider is the growth differential, more capital flows come in, and the larger is the relative value of emerging market assets, which basically drive capital flows. There is another interpretation of this chart, and that interpretation is not as benign. And that interpretation is that why does this happen? Well, because investing in emerging market is risky. If it is risky, I need to be compensated for taking the risk. What compensates me for taking the risk? Higher growth rate, higher return. For 20 years, this is a chart, almost 20 years, right? 2002 to 2015, 16, almost 20 years chart. Emerging markets have gone through lots of reforms. Big reforms, small reforms, institutional changes, political changes, major changes in how they practice policy. We have, fiscal responsibility acts in almost every other emerging market countries. We have central banks tied by the hands through inflation targets and monetary policy committees in every other listing. So emerging markets have gone through a significant amount of these institutional changes. Yet, even today, the emerging markets have to compensate developed market investors by the same amount of growth differential as it did 15 years back. None of that has reduced the risk premium on emerging markets. And that is a less benign interpretation of this chart, that even after 20 years of reforms and institutional changes, we in emerging markets still have to compensate all of this. Now I'm going to skip a bunch of these charts and go down to what needs to be done. So again, I'm going to go back to my original point that the reason why globalization or understanding globalization or thinking about how globalization affects your country is important, because even for countries like India, which are seemingly closed, that has been the critical driver of all of this, of all the pre-GFC prosperity, and at the same time also responsible for the decline in growth rate. Now, except for China, no other emerging market country is trying to rebalance their economy away from their dependence on exports and global trade and globalization to more domestic-oriented growth drivers. I'm not saying that an economy, $1,700 per capita economy like India, won't depend on external demand for growth. I'm not saying that. But if you look at the kind of policies that the government has been following, the kind of reforms that the government has been following, if you look at the design of infrastructure that government has, almost all of that today rests on the belief that global trade is going to come back. What is the point of expanding ports in India if global trade is not going to come back? You might as well stop building ports and instead build 10-lane highways connecting Kanpur to Coimbatore. That probably, if global trade isn't going to come back, building one more port may not be the most sensible idea, because you're going to be spending a ridiculous amount of money building these infrastructures. So that's the first point. The second point is that there is this almost resigned acceptance of the fact that the world has changed. Growth is now lower as a new normal people talk about. It's perfectly fine for an economy that has 40,000, 50,000 per capita economy income, whose more than 65% of its population is above the age of 70, aging population, to accept low growth. It's a completely different matter when you go to emerging market countries that they can ever accept low growth. Every country has a tolerance floor for growth and a tolerance ceiling for macroeconomic stability. You breach that floor, you breach that ceiling, politics and political economy will take over. We've seen that repeatedly happen. We've seen that in Brazil, we've seen that in Argentina, and we are watching it now in the internal changes that are taking place in the African National Congress in South Africa. We've seen that in Indonesia, we've seen that in India. These are things probably, no one really knows what these markers are, but there are lines in the sand, because if you breach those lines, you will necessarily have to pay a price in terms of political and political economy changes. So what are the kind of things that that country needs to do to rebalance? I think people need to move away from this overdependence on globalization and global trade to start thinking in terms of more dependence on domestic demand. And that, by the way, is a radical shift in not just in psychology, not just in policy making and this thing, but also in our psyche. It means that not every country under the world can stand up and say, I want to be a manufacturing hub. Somebody has to stand up and say, I want to also start to consume. In Asia, in India, it's very, very difficult for people to shift from being savers to being consumers. Saving is a virtue. We've been taught that for generations. We need to now start thinking that saving may not be as much of a virtue. And I and along with some other people have made this argument repeatedly for many years that not all savings is good saving. And I'm going to stop here. Now think about, what do Indian households save in? And I'm going to argue that many of that saving is bad savings. We save for our children's education. We save for our pensions or retirement wealth. We save for retirement health, and marriage and for housing, etc. Of this, two of them, both education and health, is a direct consequence of the lack of government provisioning of quality health and education. As a direct consequence. That saving is not done because I want to save. That is forced savings or precautionary savings, which I'm forced to do because the government does not provide me with that, with education or with that health provisioning. And it isn't a matter of only greater spending on health and education. In fact, it's probably number 3 or number 4 things that need to be done. There are significant regulatory changes that do not require expansion of public spending that can today bring down the amount of savings that we Asians or Indians in particular, Chinese do the same thing, have this massive amount of precautionary savings. I'm going to end with just one example. Think about your own health insurance. You pay a premium, and what you get from the health insurance company is a lifetime cap on how much the health insurance company is going to give you in terms of your hospitalization or your medical fees. Most economies in the world does the opposite. You pay a premium, and there is a cap on the amount of out-of-pocket expense that you have to do in a year. The part of the insurance of the medical bills beyond the out-of-pocket expense, that's in the hand of the insurance companies. That the insurance companies have to bear. And that's the right thing, Why? Because insurance companies, by their very nature, are capable, are much better able to handle such expenses rather than the individual. So, if you're an Indian household, you know that only up to 5 lakhs for your entire lifetime will the insurance company pay. The rest of the stuff you have to come out of your own pocket. So, as far as the individual household is concerned, the amount of saving that they need to do for health is literally infinite. Because I have no idea how much my bypass surgery is going to cost me when I need one when I'm 70. You change that. It's not expense from the government. You just change that rule. And you say that the out-of-pocket expense for the entire life of a individual will be 5 lakhs. The rest will have to be borne by the insurance company. Then you do know that for your entire life, you just need to save 5 lakhs for your health care. The rest, you don't need to do it. We don't have very good studies about that in India. But if you make a relative comparison to China, in China, 90 cents to the dollar is the out-of-pocket expense of a Chinese individual on healthcare. Only 10 cents to the dollar is given by the government. My guess is that that's probably broadly true also in India. Therefore, there's a huge amount of savings that's locked up in essentially a useless thing, because the government's policies and regulatory changes are forcing people to save that much. I'm going to stop over here and see if there are any questions. Thanks very much.